morning, everyone, and welcome to this PPS Investments webinar featuring Laurium Capital. Laurium Capital is our partnership fund manager at PPS Investments for the Stable Growth Fund. Now, most of you will be familiar with Laurium, but perhaps just a few words by way of introduction. So Laurium Capital has an absolute return mindset and a long-standing track record in fixed interest, in multi-asset class, and in alternative offerings. In the PPS Stable Growth Fund, our approach is really to identify a manager through our comprehensive research process with the skill set and the capabilities to successfully manage this strategy. The PPS Stable Growth Fund aims to achieve moderate returns while preserving capital over the medium to long term. The primary objective of the fund is to outperform the ASISA SA multi-asset medium equity category. The investment horizon for this fund is greater than 5 years. This morning, we are delighted to have Rob Oellerman present with us. Now, Rob is a highly capable and experienced investment manager who has managed money through many cycles over the last 3 decades. And this morning, he brings that wisdom and experience to us as we get some insights. I think we all are aware of the world we live in, dealing with pandemics, dealing with war, with inflation, load shedding, there's a lot of moving parts and a lot of challenges. And what Rob's going to do this morning is really sort of try and cut through some of that noise and distill that into what are those sort of key, what are the key moving parts that we need to focus on, and share some of his insights as it relates to the various flations. Now, of course, inflation is really a big theme right now, and we're seeing some sort of record inflation rates. In the US, we've got 40-year high inflation, but it's not just confined to the US, it's all through the world. And the lens that Rob brings is really, what does that mean for markets? What does that mean for investment strategy? And how is one able to navigate this challenging environment? So before I hand over to Rob, maybe a little bit about Rob and his track record and his history. Rob joined Laurium in December 2020 as a portfolio manager. Prior to this, he was a founding member at Anil Capital, where he was the chief investment officer. He was a portfolio manager for the equity and multi-asset class portfolios, as well as long-only and hedge fund mandates. From 1997 to 2005, Rob was at Coronation Fund Managers, initially as a co-manager and then as a manager of the Coronation Consumer Growth Fund. He spent 18 months in Dublin and London for Coronation Fund Managers, analyzing European equities. So Rob also brings that global expertise, to his arsenal of skill. Rob returned to Cape Town in 2001, was appointed head of research for and managed Coronation's segregated and institutional balanced portfolios. So what we have here is really a deeply experienced investment manager sharing some insights. So we are delighted to have you with us this morning, Rob. And I'll hand over to you.
Good morning, everyone, and to the PPS team. I've actually been involved in PPS funds one way or another since my Coronation days. Would you believe it? I was fund manager for some of the INSCO assets then, and that's really when my association with PPS began. So it's been a long and rewarding partnership, and even in our tantalum days, PPS on the insurance side have been one of the first investors that we had in our long-only business. So it's much appreciated association. On today's topic, pick your flation, what should we be wishing for? I thought it's obviously highly topical to talk about inflation. In fact, if you were to Google some of the economic topics, the most recent ones, inflation is on everyone's lips, on every headline in the financial press and even in the mainstream media. But it got me thinking that a lot of investors would be quite confused about this, the degree of news flow that we're seeing, its impact on markets, partly because over the last little while, in the financial crisis, but then also predating that, even going back to the early 2000s, deflation has been on a lot of people's lips. And in fact, I did thinking back in the early 2000s, I remember doing a radio session. I used to do a couple of radio sessions in a previous life, and I did a session with Alec Hogg on the perils of deflation. And so I just thought it would be worth a little bit of time spent unpicking these and why inflation is so potentially hurtful for investors and for savers, but then also just comparing and contrasting that with deflation. So a little bit of economic theory up front, and I thought I'd maybe share some historical perspective on inflation over time. Then just a very quick move through what is happening at the moment, 2022, some of the causes of these price moves that we're seeing, the policies that are following and are implicit in people's expectations, and then some observations, what's embedded in markets. Fourth point, really South African investor implications, because I think it's really important to compare and contrast the South African environment with where we are globally. And then just a couple of points about the PPS Stable Growth Fund, which is a fund that myself and Melanie Stockett manage on your behalf. So a little bit of economic theory, and I'm going to dive straight into it. So deflation is typically, historically has been seen as the kind of the worst evil that one can have. It's when prices fall, it's when asset values typically follow, and it's an extremely dire outcome for an economy when it shrinks and you get this kind of deflationary wave. Post the financial crisis, we had quite a strong deflationary impulse, and I'll talk about that in a second. Coming out of that, you get typically a lot of money printing. We get a pickup in activity, and you get this sort of reflationary push, which is often quite a sweet spot in an economy and in markets when you come from very low levels of inflation or even deflation to a reflation. If things get a little bit out of hand and too much money is created chasing too few goods, you end up with inflation, which is okay, and we'll talk about that in a second. I think it's generally okay up to a point, and if it gets a little bit too high and it starts to stymie real growth, then you end up in stagflation, and that's on the right-hand scale. So I'll talk a little bit about that sort of shift between deflation and inflation and the kind of perils of each. So just touching on economic theory for a second, and forgive the Economics 101F charts, but I just thought it would be nice to lay out some of this theory. First of all, deflation. You will see here excess supply. That's really can be due to two main, very kind of simple reasons. First of all, the top one, demand falls, and when all demand falls at every price, we've had that situation in Japan, slowing population growth, everyone saving, often demographics, as I said with Japan's example, that is the first cause of this excess capacity in an economy, excess supply. And so at every price, when demand falls, you get a reduction in prices. The bottom slide is the one which is slightly more complex, and you get deflationary forces kind of ebbing their way into an economy over time. It's typically when supply growth rises, outpace demand more structurally. And that's typically when you get an industrial revolution or you get a technological revolution. Those kind of productivity gains shift the supply curve to the right, and at every price. So even though demand is still rising, supply is rising faster. And again, it's a deflationary wave or disinflationary wave on prices falling. The converse applies with inflation. It's excess demand. So more demand suddenly. We get free money in the post, which happened in COVID. It happened post the financial crisis in kind of the helicopter Ben Bernanke example, money being thrown out to the general populace. At every price, demand increases, and that pushes prices up. The second one, the bottom one, is when you get a supply shock and suddenly supply changes, takes a step change to the left. And that's what we have seen in the COVID lockdowns. Factories just shut down, productive capacity was lost. And currently we're also seeing that in the Ukrainian situation. I don't have to call it Ukrainian situation, I can call it a war, I guess, where embargoes effectively take out a whole lot of productive capacity. And again, that has an inflationary impulse. And again, to jump ahead of myself, we will discuss it just now. Both of these situations have applied in the post-COVID era. And so we've had inflation or upward push on prices through both demand moves, with free money arriving in the post, people sitting at home shopping on Take-A-Lot online at home, at the same time that we've had now lockdowns and war and other embargoes. So a couple of market impacts. Under the deflation scenario, interest rates fall. That's the monetary response, but then also it's the market response. Bond yields themselves fall. That's good for bond prices and values. So that's bullish for bond prices, and they benefit the most out of all assets in deflationary times. What you do tend to see is PEs. When discount rates go lower, PEs expand. So for equities in general, they do rise. Growth equities, long duration equities benefit the most from this move into deflation. But eventually you need growth and you need pricing power. And so that's when equities which are battling for pricing power, battling for growth, start to battle, and you get this kind of what we've seen in the last 10 years, actually post the financial crisis. We've seen almost a bifurcation of the market between growth equities that can sustain growth, doing really well, but everyone else really battling to pass on any growth. Debt hurts, and this is a key theme that I think everyone needs to understand and realize is when nominal incomes are under pressure, where nominal returns are under pressure, having a static debt does not deflate. Debt stays exactly in place. When you have that in place, that's when you start getting pain out of deflation, and when kind of asset bubbles are forced to close. So really, in summary, you want, in periods of deflation, you want bonds more than equities, long duration ahead of short duration equities, and then commodities and hard assets deflate and battle the most in this environment. Interestingly, in times of stress, the correlations between bonds and equities are the opposite. So when there's a shock or stress on equities, typically bonds do well. And that's exactly what we've seen. So you have a very nice balance between those two. Under periods of inflation, interest rates rise, bond yields go up, bond prices fall. At the same time, that kind of impulse on discount rates going higher means that PEs themselves are under pressure and typically fall. So what you need to protect your equity returns is shorter duration assets, best with pricing power, able to pass on these costs, because costs are often quite sticky and you need to be able to pass them on to generate meaningful growth. Risk assets, as I said, need growth, need pricing power. Under inflation, and this is the mask that often governments wear, governments like inflation because for them, they're typically indebted, and the most highly indebted nations obviously like this most, and nominal growth ahead of a static pool of debt means you kind of reflate or inflate your way out of trouble, and suddenly your debt doesn't look so bad anymore. But under these circumstances, it's commodities and hard assets that actually typically do best, and that's what we see. Metal prices doing really well, and ahead of equities, and bonds being really worst off and most hard hit under these kind of inflation pushes that we've seen. Interestingly, again here, in times of stress, when you get shocks, both bonds and equities do badly. So inflation, and that's when you get this at the very extremes, at the stagflation push. You get bonds really battling because the inflationary impulse is still there, but then equities are also under pressure because of lack of growth at exactly the same time that yields are going higher. And that's kind of, in summary, February and March 2022. Both bonds and equities have been under some pressure, and only what survived is commodity-related hard assets and inflating assets over that time period. Importantly, and this is, I guess for all of our clients, those earning a kind of a fixed income, they have their purchasing power eroded quite substantially through periods of inflation. A little bit of a historical perspective. Now, this chart goes back over 100 years, and I've picked the US. It gives us a great data set. It's perhaps the market which is most closely analyzed and feeds through its size and power right through all the global market trends. It was obviously tension in the Middle East, the post-Vietnam era, as well as what was going on in between Israel and Egypt and the Arab states forming OPEC. That really caused a very strong impulse, the oil crisis, I guess, of 73 onwards, and really only peaked in 1979-80 after the Iranian hostage crisis, when we saw the final impulse of oil and crude shock. The green periods are periods of bouts of deflation and disinflation, strong disinflation here. And you can see that those periods really were asset busts. That was the Great Depression, caused by very high asset prices, and the financial crisis similarly, very narrow and high asset prices. And it just gives a little bit of context of the past. This is where we are at the moment. And this is post-COVID, and I will explore that in a little bit more detail just now, so I'm not going to get ahead of myself right now. But you can see the degree of impulse and why investors are rightly concerned about the move that we have seen. When have been periods when kind of markets have enjoyed inflation? Again, I've just summarized the very long term into two periods of relative stability, when central bankers' objectives, that sort of 2 to 3% Goldilocks economy or inflation really was in place. And you can see that under those circumstances, the 50s into the 60s, and then also from the kind of the 90s and the absent 9/11 and the tech bust and the financial crisis, we had a long period of relatively stable inflation over the last 20 years. And that's provided a very strong backdrop for forecasters to kind of set policy in a very coherent and pragmatic way, and not in a panicky way, which is where we are today. And those are the kind of, as I said, Goldilocks scenarios where typically asset values do well. And we're now moving in a period out of that Goldilocks. Very briefly, just before I spend a lot more time on inflation, a cautionary tale on deflation and why it's not something to aspire to. Japan, post the boom of the 80s that they had, didn't really recognize that the population growth was slowing and then actually going negative. We're very slow to react in terms of monetary policy and providing stimulus into their markets. And so over a long period of time, interest rates were low, but they never went negative, and they never really went to QE meaningfully. And you can see, it's been a 30-year bear market in Japanese assets. And a cautionary tale of ending up with no yield in the economy. If you're a Japanese saver, you effectively need to go outside Japanese borders with your investments to try and get any yield to live off over that time period. Europe has been headed much down the same path. And this inflationary impulse that we're seeing now might well turn out to be the medicine that economy needs to jolt itself out of this deflationary spiral that Japan has been in. So, quite a lot of theory, quite a lot of, what's the word, kind of theoretical discussion. So let's talk a little bit more about where we find ourselves today. I mean, the outlook for inflation, and I'll touch on it in some slides, it's really supply chain shock 2 is kind of the horror movie that we're watching in early 2022. So post-COVID, we had the first supply chain shock in factories closing down, lockdowns right through Malaysia, for instance, hitting the semiconductor chip manufacturing businesses and assembly plants in Malaysia last year. And then the beginning of this year, just as we were looking to a reopening trade, out of all of those problems, we have had the Ukrainian-Russian conflict. And that through embargo and disruption to global traffic really has provided a second supply chain shock. And I think the reality is, well, my bottom point there, China's growth is also somewhat opaque or concerning right now for another wave of COVID lockdown. So there's a lot to digest on the inflation outlook. These supply chain disruptions, the shifts in energy, can gas be imported in Europe outside the Russian pipeline complex? What is happening with labor shortages themselves, not only in Eastern Europe, but also within big economies like the US? When the Great Resignation took hold post-COVID, have some of those shortages eased? Our expectation is that they do ease later in 2022, but that's the open question. On the growth side, again, it's not a particularly rosy picture, because while we were quite bullish on growth at the beginning of this year, not ourselves only, I think it was a fairly consensus view, the entire punch bowl of cash, which has been, a font of liquidity into global markets for some time, has been drained, quite negative for global growth. And that's really on two fronts. It's not just on the fiscal side. So governments have been providing handouts to people laid off or under lockdown. That has largely come to an end through various programs, right through US, EU, Australia, Japan. So the fiscal injection to support COVID has more or less come to an end. But at exactly the same time, we've got this massive pivot in monetary policy, particularly in the US, particularly through the Fed. And so while interest rates still screen as negative real, and I'll show that in a chart, we have seen a very rapid normalization really in 3 months for that outlook, which is removing all this kind of stimulus into the global economy. China is a very key delta of growth. We've spoken about this at length over the last few years, and that credit impulse in China and the productive capacity shift in China is really key to the outlook, particularly for commodities, as their growth is quite commodity intensive still. And it's quite an awkward inflection point that we are in now in China. With lockdowns, it seems to be now affecting mainly the consumer economy in China, and the Chinese authorities seem to be slightly more relaxed about changing the outlook on the industrial side. So steel production is still continuing at a reasonable pace, despite the lockdowns that we've seen in Shanghai, as an example, of Shenzhen. But it's not quite certain how that'll play out if we get caseloads increasing in some of those industrial areas. So that's a key thing to watch out for. I look at this chart just to remind us of what Fed policy is doing and what it kind of should have done in the recent past. This is what behind the curve looks like. The transitory inflation story really played out, and the Fed got way behind the curve. Markets themselves, and perhaps guilty as charged, although we kept on having forecasts of 2.5% to 3% for the US 10-year, through the course of last year, they've taken a long time. Markets have taken a long time to digest this U-turn in central bank positioning, and we've now seen, what that short-term interest rate policy shift is doing to long rates, and we're seeing the spike in bonds. And to be fair, I think we've been quite bearish on developed market bond yields for a long time, certainly the last couple of years, believing that rates really had only one way to go, and that was higher. Not quite sure what the impulse would be that would cause that to happen, but it has arrived in the form of COVID supply chain shock, and then Ukraine, Russia. I think it's important just to digest this slide, because this inflation move, typically cost push inflation, as I've shown earlier on, when demand is higher than supply, you get these sort of supply moves at every price. They come through in goods. And typically the energy complex, as I showed at that historical slide, the energy complex has been the kind of funnel where all this stress and pain works its way through, being the oil price. And it's affected all of these economies, the US, Eurozone, UK, even in the East. And so it's a coincident move. And the maths of year-over-year changes in price means that in about Q3 of this year, it seems like the bulk of that impulse will roll over, absent new shocks. I think it's really important to think about this trajectory. And why I say that is I'll come back to just now. My belief is that the Fed moves that we're seeing and the kind of very hawkish rhetoric is perhaps now getting a little bit ahead of the curve in a way. They were behind the curve, but I think that there is a reasonable argument to be made to say that the bullard hawks in the Fed are ahead of the curve a bit. So what are the kind of signposts that I can say to you and your clients, and what are we watching out for that will maybe mean that our base case of a kind of rollover in Q3 this year might not happen? Obviously, crude oil prices. So we've seen some stability return to the market. We've seen a release of strategic oil reserves right across the world, partly replacing lost oil from Russia in the system. Is that sustainable? We will obviously follow the trajectory of the battlefield to understand some of those dynamics, and that's I think very crucial to think about. And then when new supply comes on in the gas fields in the US, as an example, the shale gas, how quickly does that come on, and does that get us into the kind of northern hemisphere winter post-September, October 2022? Another observation, this consumption mix. COVID, everyone couldn't commute, couldn't travel, spent on goods and not on services. We're now seeing a reversal of that trend. We're seeing a strong reversal of that trend. In fact, in my global fund, we're starting to position ourselves for the travel boom away, obviously, from more destinations. But that is definitely easing some of the demand pressure on consumption. But importantly, it needs to be met also by a loosening of supply constraints. So in terms of actual physical production, are we seeing an increase in vehicle production? This is kind of a great litmus paper for seeing the stresses in the supply chain right through those kind of componentry. And we get those statistics monthly. It's a great contemporaneous way of seeing the progression in supply constraints. Fourth one there, rent increases. That's been an interesting component of CPI stats, and whether we see a rollover in leases going forward will be a really important part of expectations and inflation expectations for central bankers. And then finally, watch participation rates in labor. Does that great resignation people staying away from the workplace, perhaps enjoying a different non-commuting lifestyle. Does that get replaced as we see wages increase and an incentive to return to work? And when does that alleviate some of the pressure that we see in labor markets? Commodities themselves, as I said at the beginning, often have been, well, not often, they are always in the vanguard of these inflationary pushes. But I just thought it was worth reflecting on where we are in the commodity cycle in general. This is a more than 50-year chart. The absolute value from left to right tells you that this is a pretty static series of nominal prices over 50 years. Commodities are not a great place to buy and hold your money, other than these times of inflation. And post the kind of noughties push that we saw in metal prices, which was a highly lucrative trend, and funnily enough, which didn't translate into that much inflation because we had this massive technology boost, productivity shift, helping to suppress this inflation impulse. Where we are today is kind of just halfway up the ladder, and you can read it two ways. You can read it that we shouldn't panic at this point, or you can read it that actually there's still quite a long way to go in this impulse. And as I said, I think largely the previous, our base case is that absent new shocks, we've had a lot of shocks in the system. Absent new shocks, we see a peak in Q3 of this year. But I'll touch on the observations just now. I think that there is still risk attached to that view going forward. How have markets digested this? Well, markets in terms of long bonds, and in the US, for instance, have digested a lot of it. Break-even inflation has got itself back to 3% on a 10-year expectation, well above the last 10 years. And even real yields are now flirting with the zero line, and in fact, I think are about poised to go through that zero line. And so my conclusion from this is that markets have largely internalized the current outlook for inflation. It's this one which is kind of the next big factor to watch. This is 5-year, I'm going to get quite technical here, but this is 5-year expected inflation 5 years from now. And this is what's interpreted in the market yield curve. Again, this is the US. We watch this quite closely because this is, and the Fed does too, I think, this is what markets are interpreting as longer term expectations, 5-year expectations of inflation 5 years from now. And yes, they have gone up, but this time period here in the late 2010s to 2020, this time period was, I think, when the Fed was really worried about disinflationary and deflationary forces overcoming a highly indebted society. And having this move on to around about 2.5, I don't think is a red flag. What would be a red flag is if it pushed on to above 3. That certainly is at the level of discomfort, because that's the neutral long run kind of maximum that I think inflation is tolerable for Fed policy. So this is one to watch quite carefully. And then finally, often asked about the yield curve and the shape of the yield curve. This is what markets and Fed policy, this is the kind of push-pull factors between the market and the Fed. When the Fed gets ahead of the market and the yield curve inverts, i.e. this line goes negative, typically the Fed gets it wrong and pushes us into recession. That's when they increase rates too much relative to what the market is expecting. We had a brief period of inversion. There's been a lot of talk about inversion, but actually we've had a couple of touch and goes and we haven't got there. It tells us that the Fed at the moment is slowing the economy, but still hasn't quite pushed us into stagflation yet. And I think that is a very key observation still at this point in our market view. So for an SA investor, lots of talk about the global side, global macro. I think it's important to understand that the South African economy, we're still a mining country, and commodity prices themselves, strong commodity prices still support the SA economy. It impacts our growth through the mining revenue, impacts our current account, our inflation outlook, and the fiscal revenues back to government. So a really positive boost that we get from a stronger commodity cycle. On the other side, on the downside, we've still got the SARB, the monetary policy response here. We do follow what happens in global prices. We have to. Why? Because the transmission mechanism through our currency will be severe if we don't, if we stay too far behind the hiking cycle globally. And then the third point here, we really have still a lot of constraints in our economic policy. Structural reform on electricity, private investment, confidence is still lacking. And it really needs a good kind of kick up the behind on the policy initiatives for us to get much more confident on the outlook longer term for the South African economy. The fiscal policy as well, we spent more money than we have in the COVID time. We've got the basic income grant, we have public sector wage pressures, we have Eskom and its problems. So these are all big pressures on our fiscal policy, but things cyclically have got a little bit better. And then, the next point, the elective conference politics is never far from our economic outlook in South Africa. And so the contest at the end of this year will be important for us to understand the outlook for South Africa. And just again, the final point, sorry, to miss that one. Within South Africa, we can't have our balances too far out of kilter at the time when the whole world is draining liquidity out of the system. A risk aversion trade here is a very thin trade, and we can get real spiky moves in our currency if we get complacent about our position in the world. Fortunately, we're not, and fortunately, the starting point is much more bullish than that kind of my scare story at the bottom, and I'll show that in a couple of slides. First of all, this one, our terms of trade. So why are we all, I think, quite bullish about the outlook for the rand? The terms of, when I say, we don't think the rand's going to 10 or 12, but there are a lot of things that are supportive of the rand in this circumstance, predominantly this slide. So when metal prices do better, go up more than oil prices, this terms of trade is a great index. It's produced by JP Morgan. It just kind of shows live over a period of time our South African terms of trade, and the higher the better for the rand. And you can see we've been kind of in the depths of despair when commodity prices all fell. Currently, it's generally quite a rosy terms of trade picture. This is important because if you look at our current account surplus, now it's almost going. You have to go back to the 80s to find another kind of parallel period when our exports were so much more highly valued than our imports and on volume. So I hope that the Durban port issue, fortunately, it hasn't hit Richards Bay in terms of exports, but we need to see our exports continuing to pump ahead of imports for this to stay high. And that was very different from this time period. If you think back to when interest rates in the US started to scare markets in 2013, this time period here, we were in the depths of a current account deficit and very vulnerable. Whereas now I think we're slightly more protected from this risk aversion trade. What is reflected in the South African markets, our risk premium on a 10-year view is pretty high. And this is the reason why we continue to be quite constructive on SA bonds over developed market bonds. We think we already have quite a high yield. And if you compare us to our emerging market peers, we have an exceptionally high real yield against our other emerging market peers. And so when you ask us, how can we invest in South African bonds at exactly this time of global stress? It's precisely because with the commodity push on inflation we get a reasonable amount of comfort that the SA yields already at these very high levels are discounting a lot of the pain. So some concluding observations. I'm conscious of time. We think there are heightened risks for a longer cycle, and I've given a couple of indicators for that. Our base case is that inflation, despite this push, rolls over in kind of Q2, maybe Q3 of 2022, and that we don't go into stagflation, that there is enough of a growth impulse in the US, possibly in China with some stimulus, that we don't get caught up into global stagflation. Policy expectations generally, I think, have caught up with these events. And in the absence of a new shock, I think that they are partly ahead of reality. And I've given you a couple of stats, I think, that are worth thinking about and watching about the tension points in this inflation view. The market outlook, I think I'm hoping that some of this historical perspective, if you look at things over a very long period of time, I urge you to actually, I've got a book along here that I've been rereading, Barton Bigg's book. It's called Wealth, War and Wisdom. I don't know if you can all see it, but if you're interested in some weekend reading on the long weekend, I'd recommend it. It's an analysis of kind of post-war markets and what markets, how quickly markets digest war events. And so in this Russian-Ukrainian crisis, it resonated with me just to go back and think about the kind of long-term effects of that. The long and the short of it is that both for victor and vanquished in war circumstances, he does a long-term analysis. Under both those circumstances, sticking through markets, particularly equity markets, is still a rewarding endeavor. But for sure, you want to be on the winning side rather than the losing side. And I think that's it sounds trite, but I use kind of these historical economic analyses to help me calibrate my thinking through times of stress. I think market valuations have already factored in a lot of this stress and these inflation effects. But if we do in the portfolio take action, it's because we're looking to hedge our risk. So we're probably holding on for longer in the commodity equities and the commodity complex, and you see that within our equity selection. We've bolstered our US dollar holdings more recently, and I'll talk about that just now. We're looking for pricing power in every equity that we pick. We prefer value to growth. There is definitely still an opportunity to find businesses which have fallen more than most, and give you a little bit more of a margin of safety in expectations. SA yield is attractive in the context of a global reflation or inflation trade. And then finally, gold. Gold is a bit of an enigma. It's another whole topic. Suffice to say, we do have gold in the portfolio, both miners, and I think that the outlook is more positive for gold under these circumstances, even though it has not done all that well under this initial inflation push. Very briefly, the PPS Stable Growth Fund, which we manage, 30 seconds on Laurium Capital. We're a 40 billion asset manager. Tantalum and Laurium, we merged, as Anil pointed out, December 2020. We've got a strong team of fund managers right across the board, managing SA equities, multi-asset, and now also increasingly global. We eat our own cooking. We invest in our own funds, and have a very strong boutique culture within Laurium. So I think that the business has a long runway of success ahead of it. The fund itself, turning 4 later this year. Myself and Mel Stockett, who I think many of you will know, she manages the bond and yield component. She and I have worked together for more than 20 years as a team, and we have a very strong understanding of the push and pull between the various asset classes in a long kind of in a long-term context. This is the team that we part of with Laurium, the founders of the business there, Murray and Gavin and Brian Thomas, again, who many of you will know from webinars and other retail interactions, heads up our asset allocation process, and with Mel and myself. So we've got a very strong alignment of long-term thinking and tactical asset allocation. Just looking at the fund itself since inception, the asset allocation, reasonably long-term strategic. So we have a base case that we work off. I wanted to point out a couple of things. We have been increasing the kind of rand hedge component of SA equity more recently, and I'll talk about a couple of names there. Foreign equity is less obviously attractive now, although there's a lot more value that's emerged, and certainly I'm actually quite interested in the opportunity in both EM and in Europe in the foreign equity space. And then we have increased very recently this brown, again, taking more US dollar cash offshore when the regulations allowed us to do that. So that's certainly a hot topic of conversation in asset allocation circles right now. Two stocks. Those of you who've heard me speak before about equity selection will know that I'm not a smoker, but I'm a tobacco bull, and we have started to see a nice ride up in British American tobacco, which is one of the core holdings in the fund. It has pricing power. It gives us good yield in a basket of currencies. And so in times of stress, it's really a great anchor to the equity allocation within the fund. And we've had a nice move upwards. There's a lot more to go in this share and in this its basket of next generation products. So I urge you to watch this one still. I think that there's still a good runway here. A name that it's not on our top 10 list in the 31st of March slide that I'll show imminently, but we are involved in buying more of this at the moment. This is Mondi, which has fallen substantially with the Russian invasion of Ukraine. It has assets in businesses in Russia, up to 20% of its value, but it has fallen by more than that order of magnitude. And so this is one of those where we think the commodity cycle, the pricing that it is getting, it's able to achieve positive margin leverage out of that. And the market has punished it even more severely than its Russian exposure. So this is where, you know, the kind of name on the commodity side that we are building a bit more exposure to. I'm going to stop on this slide. This is our current fund holdings, and top to bottom you can find this information in our fund fact sheets. And you know, you're welcome to get in touch if there's anything that's you know, of interest going forward. I'm going to stop sharing there, Anil, and welcome to ask me some questions.
Awesome. Thanks very much, Rob. So I'm going to kick off with a question from Vishlan Naidu. And he says, while strong commodity prices are generally supportive of the SA economy, I understand SA's mining production is still below pre-COVID levels due to power, transit issues, etc. Is South Africa well placed to take advantage of the strong commodity prices?
The observation is 100% accurate. Great question. That volumes are still the bugbear that we have. We've not been able to unlock volumes in our mining industry. It's not just Eskom and Transnet that are causing that. Sadly, over a long period of time, we've had underinvestment by the mining companies themselves in kind of brownfields and greenfields expansion within the boundaries of South Africa, primarily because it's been an investor unfriendly environment. We had lack of certainty around kind of rules and regulations for the mining companies to invest more. And in some ways, prices are reaping the benefit of that underinvestment, i.e. it's keeping the market tighter globally. You know, I'm talking about things like the platinum and palladium group metals as an example, where South Africa has a lot of the new productive resource, but it's not arriving where it needs to arrive. But it's right through the chain of mining resources. So we could do better for sure, but the price rises are good for us, unequivocally good for us.
Thanks, Rob. And then the second question from Graham Lovely, Naspers, the top holding. Is this a legacy position, or would this now be seen as value and less long duration?
Yeah, Graham, it's a great observation, because I think it's been a painful investment, not only for Laurium and PPS, but also for many South African fund managers, and it's changed from, earnings growth has disappointed, there's no doubt, and it's primarily because of regulatory interference in these kind of Chinese online operations, not only gaming, but also through media and online trade. This position, there is no such thing as a legacy position. In our funds, we debate actively at every meeting, and probably perhaps even every day for the last probably the last 18 months, we've been debating and analyzing and repositioning the Naspers process within the complex, outside, upweighting, downweighting. So it's not as if it has a God-given right to a place in our asset allocation, but the share itself, Naspers, before you even get to Tencent, there's a significant opportunity to create value in the hands of the management team, which we believe fundamentally makes it a position worth having in the fund. There is a significant discount attached at the holding company level of Naspers and Process before you get to Tencent, which in our eyes, last year's actions to unlock that discount were very disappointing, but we think that there is still an opportunity to unlock a lot of value in that position.
Thanks, Rob. And then, so we've got a few more minutes, so maybe we can get through a few more additional questions. One from me is really, I guess, markets, corporates, consumers, have become accustomed to the liquidity support from the Fed and central banks over the last decades, but not just the liquidity support, also the sort of low, structurally low interest rates. And I guess it seems like both of those sort of levers now seem to be going into reverse mode. And perhaps just sort of any thoughts you have in terms of implications for sectors or companies that you would prefer to look at in that environment, and sort of just how navigating that shift of loose and cheap money to suddenly tighter and more expensive money.
That's a great question, Anil. And it goes to the heart of perhaps every equity debate that we're currently having in the house is the franchise that we're investing behind when we invest in a company. It's right to exist, and it's economic value creation, typically through pricing its own products. Now, I say that in the context of overweighting and holding a reasonable amount of commodities within our complex that have got, in theory, zero pricing power through the cycle. They are price takers. But at this point in the cycle, with supply being so tight, with ESG and a host of constraints around making new capacity in place, under those circumstances, we've seen a stronger for longer commodity cycle, which is, as I said earlier on, it's one of the reasons why we've hung onto those equities. On the consumer side, where the consumer has been used to almost free money, mortgage rates being low, I think that this shift that we are seeing in interest rates, and a reminder of perhaps what normal looks like, because what we've had, as you rightly point out, I think was an abnormality. Very low rates of interest, very free money, almost no inflation. It's nice to remember, but I think it's gone for now. Under those circumstances, we want to invest behind businesses which can monetize prices, can keep their trajectory of growth positive in an environment like this, where costs go higher and typically demand will be under pressure. So I think it would be wrong for anyone to think that it's business as usual when you get these kind of moves. That's not my message. My message is that markets have internalized a lot of the pain. And if you look back over the fullness of time, these impulses cause stress. They have caused stress. And things will change, will be different for a number of years. But that markets are, evolving mechanisms. They are very quick to anticipate and calibrate these shifts, many of which have been already digested in markets. And there are opportunities definitely in the equity universe to diversify your way into the pricing power that we crave. So that's a really important message. It will be tougher on the consumer side. I think it'll be tougher in markets in general. I think to deliver real returns, inflation beating returns, is an ongoing challenge, and more challenging when you get these kind of moves.
Thanks, Rob. And then maybe just a last question stroke comment. I mean, I think, the one thing that really stood out to me out of the presentation was the South African real bond yields. It does look like a really sort of attractive prospect, to almost have this potentially really good real return coming out of this sector, and it puts us in a really good place. Is that something that you guys are also excited about? And is that something that you feel is possibly one of the lower hanging fruits out there in terms of generating real returns?
100% agree with that. It's, South African bond yields, real and nominal, are amongst the most attractively priced in our global universe that we follow. We also have a product where we manage an African Eurobond portfolio, and similarly across Africa, you're getting almost double-digit returns in our African bond fund, which is very attractive in our eyes. So, absent inflation going from where we think the likely rollover is to the double-digit level, I think bond yields in SA and in even frontier markets like Africa have very much internalized a lot of this stress and are very attractive. So we are quite long duration in our SA bond portfolio, despite our view that US 10-year maybe still has legs to move higher. Certainly north of 3% is on the cards. And that typically is going to be a little bit of pain, but we don't invest for this week or this month. We've got to take a view as investors of where the big opportunities lie and where the where the real yields are most lucrative, and discount all of the risks. And we think that SA bonds are still an attractive place to invest.
Awesome. Rob, with that, I'm going to say thank you very much for sharing your insights and your wisdom. I think you really gave us a lens of looking at markets with all these multiple moving parts, and you really sort of narrowed the focus to look at some key issues. And I think the inflation issue is something we're going to have to watch for the coming weeks and months ahead. So you've given us a lot to think about. You shared some really amazing wisdom with us, and I'd like to say thanks very much to you and Laurium for your time and contribution. Also want to just say to everyone attending that Rob will be in Johannesburg early May, and so if you'd like to meet with Rob, have a coffee with Rob, and maybe just follow up on some of what was discussed, please contact your investment specialist, and we will be confirming dates and times over the next few days. And then there were also a few questions regarding the book. I think it was posted in the chat, but the title of the book is Wealth, War and Wisdom by Barton Biggs. So if you've got some reading material for the coming long weekend, enjoy that. It is economic history is fascinating to me, and I think that'll be very helpful to try and get some context as we navigate what's coming. So thanks very much for everyone for attending. We really appreciate it. And on behalf of PPS Investments, we'd like to say thank you to everyone that was here. All the best. Bye-bye.